The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, this is Ejaz Khan, your trainer for financial management P2P sessions for March 2022. I hope you people are doing great, and if you can just confirm that I'm audible to all of you. Okay, so more and more students are joining. I think uh, we should wait for a minute so that maximum students join the session so that they don't miss anything. Meanwhile, if there are any questions uh, related to this P2P session, so you people are free to ask me. Yes, yes, I'll be providing you people with a link to join my Google Classroom, and in the Google Classroom, I'll provide all the resources in a very structured way, and you can use that Google Classroom till your exams to go through all the study material in a structured way in a sequence. Okay, I've got a question from Kesser that if we use a formula and do not show working, will we still get marks? Well, Kesser, I'll just respond to those technical questions while I'll be delivering these sessions. For the time being, I'm just asking for questions related to these 4 day sessions. If you have any queries related to that, you're more than welcome to ask. As far as the technical questions are concerned, that will be definitely covered during these 4 days session. So now, may I know what error are you getting? Yeah, obviously recordings will be available. Okay, I think maximum students have joined. So let us start this session now. Uh, well, before I start the session, let me clear the objective of uh, this P2P 4 days session. Uh, as you know, that the name is practice to pass. So more focus will be on practicing the questions, and while we will be solving questions, uh, I will also be going through few basic concepts as well Obviously, there are total 12 hours available for this session. So um, the conceptual understanding, the conceptual discussion will not be that much in detail, but I'll try my level best to explain as much as I can during these 4 days. Um, but my focus will be on the key questions from the MCQ sections, from the CRQ sections, and from the MTQ sections. And I'll try my level best to focus on the techniques that will help you people to pass your exams um, in both the three areas of the exam. Um, I have selected questions. I have selected questions with the same objective so that maximum areas could be covered and maximum techniques could be taught. But once these 4 days session is the session is over, after that, through the Google Classroom, I'll be providing you people with all the resources that will be helpful for the next 10 or I guess um, there will be I guess 15 more days, right? Before the exam. So for the rest of the 15 days, you will have all the material that will help you prepare for the exams as well, even after the session ends. Yeah, 22 days from now, but by the end of the session, you'll still have 15 to 16 days. Obviously, Anas, it's always possible. It's always possible. You can always work hard and still you have enough time left for the before the exam, so you can prepare. I won't say easily, but yes, if you work hard, as you're saying, you will be able to. So let us start now. Today I'm starting with the investment appraisal, and I'll try my level best to cover as many questions related to investment appraisal as I can. But my support will not end after these 4 days. My support will be there till your exam day. Now, let me give you a quick introduction of this paper, financial management paper. Financial management as a subject, uh, the whole syllabus revolves around the objective of financial management. The ultimate objective of financial management is to maximize shareholders' wealth. So, whatever we will be studying, or whatever you have studied so far, or whatever you will be studying till your exam day, the objective will be to maximize shareholders' wealth. And when we say maximize shareholder wealth, we actually mean we will be increasing or maximizing the net worth of the company. That is the total value of the company. And for a listed company, it is the share price, right? So maximizing the share price will be the objective uh, of a company that is listed on stock market. So different syllabus areas of financial management, all of these areas will have the same objective. Like the syllabus areas that we have, one of the key areas is investment appraisal. Again, the objective of investment appraisal is to select best projects that will help increase the value of the company. Then we have cost of capital. We have business valuation. We have sources of finance, risk management, working capital management, financial management function, and financial management environment. The ultimate objective of all these areas is to maximize shareholders' wealth. Okay, I have one request from all of you. I'll be answering everyone's questions, but I'll be taking um, breaks in between whatever I teach you people, and in those small breaks, I will open the stage for questions and answers. So till then, just hold your questions because I cannot see your questions and I can and screen at the same time. So I have to switch from screen to questions. So that's a request. If you can just hold your questions for now, and I'll allow you people to ask me questions. Now, how do we maximize shareholders' wealth? The shareholders' wealth could be maximized by taking right investing decisions. That is, investing in more profitable projects. Secondly, financing decisions, better financing decisions, that is, acquiring finances from relatively cheaper sources so that we have a lower cost of capital, and by using funds that are cheaper, we can actually maximize the wealth of the shareholders. And then it's dividend decisions, because the dividend decisions or dividend decision has a direct connection with finances of the business. So if the company pays out all of its profits as dividends, it will have no capital available for reinvestment. But if it holds some part of its capital, so some part of its profit, it will have funds available for more projects. So dividend decisions are also linked with maximizing the shareholders' wealth. So that was a brief introduction of this paper, and without wasting further time, I'll just directly jump to questions. And during these questions, I will try my level best to explain the concepts in as much detail as possible. So let us start with CRQ first, and we have a very good past exam question. I'll start with that question first, and there is a reason why I'm calling it as a very good question. Let us read the question first. And Often company is a large company which is listed on a major stock exchange. The company has been evaluating an investment proposal to manufacture product K3J. The initial investment of 1,800,000 will be payable at the start of the first year of operation, that is initial investment. The following draft evaluation has been prepared by junior employee. Now, we have already been provided with the draft calculations by a junior employee, and there is a reason why they are calling the person as a junior employee. So let us go to the question first, and then I'll explain why they have given this question. The sales volume they have been given, selling prices for each year, variable costs given. The above selling prices and variable cost per unit have not been inflated. They have not been inflated, so they have been reported as they are now. And now they have provided us with an NPV pro forma. At the end of the pro forma, they have also given us the NPV figure. So this junior employee has calculated net present value, and we have been given additional information by the junior employee. That is, the relevant fixed costs are forecast to be 150,000 per year. Sales and production volumes are the same, and no finished goods inventory is held. The corporation tax rate is 22% per year, and tax liabilities are payable 1 year in arrears. Often company can claim tax allowable depreciation at 25% per year on a reducing balance basis. On the initial investment, the balancing charge or allowance can be claimed at the end of the 4th year. It is expected that a selling price inflation will be 4.2% per year, variable cost will be 5% per year, and fixed cost inflation will be 3% per year. Investment has no scrap value. The investment will be partly financed by a 1,500,000 loan at 10% per year. Cost of capital is 12% per year. And what are we supposed to do is prepare a revised draft evaluation of the investment proposal and comment on its financial acceptability. We have to prepare it again. And the reason why we may be required to prepare it again is that it has been prepared by a junior employee. So there is a chance that this junior employee may have made mistakes while preparing this NPV. So let us do it as per our understanding. So let me start. So we always start NPV pro forma from year 0. Then we have year 2, year 3, year 4. And because taxation was in arrears, we need to have an additional year, that is the 5th year. And this 5th year has been added just because the tax is being paid in arrears, that is 1 year later. So this will be stretched to 5 years. And since figures are in thousands, so better to apply degree of precision like they have done. Okay, firstly, let's start with sales. The sales volume for the first year is 95,000 units. So I'll just write 95 instead of writing 95,000, as we have already put 3 zeros here. So 95 in, and it should be multiplied with 25. And if I multiply it with 25, I'll get 2375, right? But as we were told that these prices haven't been inflated, and in the additional information we are being told that there will be an inflation, and in the price we expect an inflation of 4.2% per year. So we have to adjust this inflation right from the very first year, as inflation wasn't adjusted. So since you will be doing this question on spreadsheet in the exams as well, so remember the formulas that I'll be using. So into 1 plus 4.2% raised to the power, and I'll link it with this 1. So it is power 1, right? There is a reason why I have done so. So I have linked the power with this cell, and I'll just press enter, and it has inflated the figure. Now I do not want the figures to be in decimals. So in order to reduce the decimal places, I'll just go there. You will have this option in your exams as well. So reduce it to 0, and also just change the format to accounting format by pressing this. And again, it has shown 2 decimal places. So let me do it again. Now it's showing in accounting format 2475. So 95, that is the sales volume, into the price, but the price was quoted in current price. So we have inflated it raised to the power 1. Now, what I'll do is I'll just copy this formula and paste it in the rest of the 3 years. And now I'll just make changes accordingly. Like I'll just change the price in case it is different from year 2, since the price is the same for year 2 as well. So I won't change the price, but the sales volume has to be changed, as for the second year the sales volume is 100,000 units. So instead of writing 95, I'll just write 100. So by copying the formula, I do not have to restructure the formula. The structure of the formula is already there, and I'll just make the necessary changes. So I'll keep the price as it is. The inflation rate will be the same, and now the power should be 2, but I don't have to change it because I linked the power with this cell, so I don't have to change it again. Now it will automatically be changed. You can clearly see now the power is Q191, right? So which is 2. So it has already changed the power, so I don't have to do anything. So 2714. Then I'll come here and I'll make changes, and instead of writing 95, tell me what should I write? What should the figure be? Instead of 95, what the figure should be? Okay, great. It should be 150, right? Yeah, 150. And do I have to change anything else? Yeah, I have to change the price as well, and I should change it to 26. And remember, these prices quoted here are without inflation, which means all of these prices have been quoted in current price terms. So if any price has to be applied in year 3, it has to be applied thrice. It should be inflated for 3 years. So the power should be 3. Okay, now tell me the changes that I have to make to the 4th year. What should be the sales volume? The sales volume has to be 150. The price will now be 27. Okay, do I have to change anything else? No, no need to change anything else. So I'll just press enter to apply the formula, and it's 4774. Now you people can clearly see that the first year figure calculated by the junior employee is the same as we did it. But from year 2 onwards, our figures do not match. So obviously this junior employee has made a mistake. Now let us figure out what mistake has he actually made. So I'll just copy this formula just to show you people what mistake he probably may have made. I'll just Let us remove the power sign. See, now our figures are matching. 2605. He has also mentioned as 2605. What I did is I just inflated it once, that is 1 plus 4.2%. Whereas the junior employee was supposed to inflate it for 2 years. The junior employee assumed as if this price was for year 2. Whereas you can clearly see they have mentioned that the prices haven't been inflated, which means that the product will be sold for 25 if it is 2 years old product, but not after 2 years. The same product, if it's 2 years old, that is, it's the second stage of its life cycle. Let's say in the second stage of its life cycle, you can sell that product for $25, but if you sell it today, so all these prices have been quoted in current price terms. So for year 2, it has to be inflated twice, whereas this junior employee has just inflated it once. That was a mistake he made. I hope it's clear. Is that clear? So make sure you people do not repeat this mistake in your exams. Maybe you get a similar type of a question. Okay, then let's move towards the variable cost. Let's move towards the variable cost. And for variable cost, I'll start with a minus sign so that it shows a negative figure. Minus 95 into 11, and we have to go to that inflation part of the question to see what was the inflation rate for variable cost. The inflation rate for variable cost was 5%, so we have to adjust it accordingly. So is equal to 95 into the variable cost of the first year into 1 plus 5% raised to the power 1, and it should be a minus figure. And let us copy and paste it is a live question and I am answering your questions, Adnan. So let us make changes. Okay, what do I have to change? I have to change the volume from 95 to 100, and the variable cost per unit has to be changed from 11 to 12, and the rest of the things should remain same. Similarly, we have to make changes here as well. It should be changed from 95 to 105, sorry, 150. 150, and the variable cost has to be 12, and the sales volume again should be 150, whereas the variable cost should be 13, and everything else will remain the same. Okay, now we should continue with their format, right? So let us write fixed cost as well. According to the question, relevant fixed costs are forecast to be $150,000 per year. So it should be $150,000 per year, and again there will be inflation applied to fixed cost, and the fixed cost inflation is 3% per year, so we should be using the same rate. So 1 50 into 1 plus 3% raised to the power 1 is 155. And if I copy this formula and paste it here, and then here, and then here, so it will make the changes accordingly, since fixed costs are not supposed to change in the rest of the year except for the change that is going to be there because of the inflation. Otherwise, there is no other change in the fixed cost. So we don't have to change this 150. It is only the inflation which is increasing the fixed costs. So is that clear? Okay. Okay, now let us move forward. And now this junior employee has also shown interest payments of 150,000. And let's see, why has he shown this interest payment? Because this project was partially going this project is partially going to be financed through a loan. Here we go. A loan has to be sanctioned at a 10% per year interest rate, and if we take 10% of this 1,500,000, it will be 150,000. Then that's why he has shown this interest payments in this NPV calculation. So do we have to take this amount as it is, or do we have to make some changes? Is it the correct figure and we should be taking as well? Okay, you people are suggesting that we should not be taking interest payments, right? Excellent, Adnan. That's the justification. That's the reasoning. That's the reasoning. Yeah. Since we are already applying our cost of capital at the end of our calculations, we will be using cost of capital to discount these cash flows, and cost of capital will always have the cost of debt portion in it. So there is no need to show interest payments as cash outflows. So we will simply ignore interest payments. So everybody else, you should always remember that we never take interest payments as our cash flows. And if at any point of time examiner asks you the reason why we do not incorporate interest payments, the reason is that interest is always adjusted through cost of capital. That's why we do not show these interest payments. Okay, after interest payments, okay, after the fixed cost, now we have to make sure that there is no other operating cash outflow. There isn't any other cash outflow, right, which will be affecting our tax. So let us calculate the net figures, the net cash flows, the net operating cash flows, I would say, before tax cash outflows. So what I've done is I've just added these three figures. It will automatically adjust accordingly. 1, 2, 2, 3, and I'll just copy this formula and paste it to get the net figures for each year. So that's pre-tax cash flows. Then comes tax, and the tax rate was 22%, and it was supposed to be paid in arrears. So we'll be starting showing the tax payments from year 2 onwards, and tax is always an outflow. So it should be shown as a negative figure into 22%. Abir, which part you are talking about? Which part are you talking about? Why you have not taken interest payments, Rahila? Okay, Rahila, since we will be discounting these cash flows later on using the cost of capital, therefore, if I discount the cash flows using the cost of capital and I also show tax interest payments in the pro forma, it would mean that I'm showing interest payments twice in single question. So either we have to show interest payments as cash outflows, or we should be adjusting it through cost of capital. We cannot do this both. So since we are already using cost of capital as our discount rate, therefore we are not showing interest payments as our cash outflows. So what you've done with fixed costs? I've just inflated the fixed costs. Fixed cost fixed cost was 150,000 and it was supposed to be inflated at 3% per year. So I've just inflated fixed cost at the rate of 3% every year. Yes, sir. Is that clear? Okay. Abhi is saying define pre-tax cash flows again, please. Pre-tax cash flows is just the net of these three figures. Net of these three figures. We have a cash inflow of 2475 in the first year. Then we have two cash outflows in the form of variable cost and fixed cost. So we are deducting these two cash outflows from our cash inflow. And this is what pre-tax cash flow is. Okay, so the tax for the first year will be 22% of the first year's pre-tax cash flow, 269, right? And in the third year, it will be the second year's pre-tax cash flow into 22%. And now I'll just copy it and paste it. So these are the cash outflows. Yes, Kessa, we can do it directly. So these are the cash outflows. Now there's very important thing that you should all listen to carefully. I just applied the 22% tax rate on this figure 1, 2, 2, 3. And as a result, I have got 269. Right? So I've shown a tax outflow of 269 by applying 22% to this figure. Now, what actually will happen is that when the tax authorities they will apply tax, they will not apply 22% rate on this figure because they will allow tax depreciation as expense. So they will reduce this figure by the tax depreciation amount and then they will charge us the tax. And if this figure is reduced by the tax depreciation, it will obviously reduce the tax liability as well. And the tax outflow will not be 269,000. It will be less than 269,000. But since we haven't shown that tax depreciation, therefore our tax is overstated now. Now, the reason why we haven't shown tax depreciation in our NPV performer is that tax depreciation does not involve any cash outflow. And when we are calculating NPV, we make sure that we do not include any expense that is non-cash. So tax depreciation or accounting depreciation, they both are non-cash expenses, and therefore we never incorporate it into our NPV calculation. But because of not incorporating here, our tax figure is overstated. Now, what actually will be happening is that the tax authorities will be allowing us tax depreciation before they charge us with the tax. So let us see how much tax depreciation they will allow. The cost of the asset is 1800,000 and the tax depreciation rate was 25% reducing balance basis. So for the first year, the tax depreciation will be 1800,000 into 25%. It is going to be 450,000. So what? Now let me write it in thousands. 450. So the tax authorities will first subtract this 450 from our pre-tax cash flows. They will get taxable income of 773 and then they will charge us tax on this amount, that is 22%. So the actual tax that we are supposed to be paying will be 170,000 for the first year, whereas we are showing it as 269,000 just because we did not subtract 450,000 from this figure because of its non-cash nature. But if we don't do this, our tax figure, which is actually going to be 170,000, but it is shown as 269,000. So by how much is this tax figure overstated? Tell me. Is it now okay? Is my voice okay now? Okay. So the tax figure is overstated by $99, right? And how did we calculate it? The figure we have shown here is 269, whereas the actual tax figure is going to be 170. So it's overstated by 99. So what are we supposed to do? If this figure is overstated, that is overstated by 99, how do we adjust it? What's the way out? Reduce this figure by 99, or we should add back 99. Simple. We should add back 99. It will automatically adjust the tax figure. It will automatically adjust the tax figure. The 773 figure is just after subtracting 450 from this amount, and 450 is the capital allowance figure, the tax depreciation. The tax depreciation is 25% of the cost of the asset, which is 450,000. Then the tax authorities will subtract 450 from 1223. It will be 773, and then they will charge us at the rate of 22% on this amount. $170. And now if we compare the tax figure that we have shown with the actual tax figure, we can clearly see there is a difference of 99. That is, we have shown an overstated tax. So we have to adjust it by adding back this 99. Now this was just to explain how you will be doing it in your exams. You have to show it as tax benefit because this is a benefit. This capital allowance figure is reducing your tax. So that's why we call it as tax benefit on capital allowance. So how do we calculate this 99? We have to show our working, right? So how do we show it in on a spreadsheet? We will just take the cost of the asset, which is 1800,000, and we will multiply it by 25%. Once we multiply it with 25%, we will get the capital allowance figure, which is 450. And on this 450, we are going to get a 22% tax relief. So simply multiply it with the percentage of tax, and we will get the same answer, that is 99. Here we go. So we've got the same answer. So just look at the formula. The cost of the asset into the depreciation rate, which is 25%, into the tax rate to get the tax benefit. So just write OK if it's clear. Quick. Great. Now, can you people just tell me what will be the capital allowance? I'm not talking about the tax benefit, right? I'm just talking about the tax depreciation, capital allowance for the second year. Can you people just tell me what will be the capital allowance figure for the second year? Everyone, what will be the tax benefit, said capital allowance? I'm not talking about the tax benefit, remember. I'm just talking about the capital allowance figure. What will be the capital allowance figure for the second year? As you know, that it's the reducing balance method. So each year, the 25% rate will be applied to the WDV of the asset. That's the written down value of the asset. So the cost of the asset initially is 1800,000, which was depreciated by 25%. That is, it was just left as 75%. So if I take 75% of the cost of the asset, I will get the WDV after first year. And it is going to be 1350. That's a WDV. And on the WDV, we will again apply 25% depreciation. And if you apply 25% to this value, we will get the capital allowance figure for the second year. And it is going to be 338. Now tell me what will be the tax saving. There's a difference between capital allowance and the tax saving. The tax saving for the next year will be 22% of this amount. 74.25. This is the amount that we will be adding here. Now how we can show it directly. Now I'm showing you a shortcut. I'm showing you a shortcut which will give us the same answer. Tell me, what's the depreciation rate? Yes, Faisal, I can see your messages. The depreciation rate, this depreciation rate is 25%. That is, each year, the value of the asset is reduced by 25%, and as a result, the tax benefit will also reduce by 25%. So in year 2, the tax benefit is 99. In the second year, it will be reduced by 25%. That is, it will be just left as 75%. So I'll just take 75% of the previous year's tax benefit, and I'll get the same answer as this one, 74, right? Here we go. I just took 75% of the previous year's depreciation. So no need to go through the whole calculation again. Just reduce the previous year's tax benefit by 25%. No, there is no need to show working separately, and that's what spreadsheet is all about. If examiner wants to see how you arrived at this value, he can simply click it and he can see your working. He can see your working, that you have done the work, you have shown the working. So no need to show separate working. This is the working. Cost of the asset, cost of the asset, and then it should be reduced by 25%. As for the second year, the WDV will be 75% of the cost of the asset. And then we should multiply it with the depreciation rate, which is 25%. I hope that's clear. Okay. What should I do for the second year? Just write the formula. Everyone, just write the formula. Don't tell me the answer. What should be the formula in this cell? Faisal, Faisal, it should not be 22%. It should be the 75%, because every year the cost of the asset is depreciating by 25%. So the formula should be the previous year into 75%. It's 56. Now, a very interesting calculation will be in the last year. In the last year, what are we supposed to be doing? Now, let me show it here, and then I'll apply the shortcut there. Right? So in the last year, what is going to happen is, firstly we have to find out the WDV for the last year. And since we know that the asset is already depreciated for 3 years, so WDV at the end of the first year will be 1800 into 75%, right? That is 1350. Then the WDV at the end of the second year will be further reduced by 25%. That is, it will be left as 75%, and it will be 1012. WDV for the third year will be 75% of the previous year. That's the WDV for the third year. So after 3 years depreciation, this is going to be the written down value. And since now we are in the fourth year, that is the last year of the business, we do not have any other year coming up. That's the last year. So we cannot claim the remaining cost of the asset, that is 759,000, in the subsequent years. So we have to claim this amount as our tax expense in the last year completely. But there may be a chance that we may be able to sell this asset after the end of the fourth year at some price. Say for example, I'm just giving an example. Say for example, we have a scrap value and we can sell this asset, which according to tax authorities has a value of 759,000. We can sell this asset, let's say, for 200,000. So first we have to subtract 200,000 as we are recovering this amount. So tax authorities will not allow you to claim the complete 759,000 as expense, since you are recovering 200,000 by selling the asset. So what they will do is they will reduce this last year WDV by the scrap value. After reducing it by the scrap value, the net amount will be 559,000. And we can say this is the amount of, or this is the cost of the asset that we still haven't claimed as expense. So this amount will be allowed as an expense in the last year. And this amount is called balancing allowance. So it's not a scrap value, it's called balancing allowance. So I've just assumed that there's a scrap value of 200,000, right? But we have to check the question whether there is any scrap value or not. But that will be done later on. I'm just explaining it. If in case there was a scrap value, what would have been the treatment? So we will subtract this 200 amount from the last year's WDV, and we will get the balancing of allowance figure. And this whole figure will be allowed as tax expense, and it will reduce our tax by 22%. So we'll just apply 22% to this figure. So we can call it tax benefit on capital allowance. Sorry, on balancing allowance. Yes, Kessler, it should have been done in the year 4. But since tax is paid in arrears, so we started from year 2. So this is our first year. This is for the second year. This is for the third year. And now we are doing it for the fourth year. So that's the tax benefit which should be shown here, right? 123. Now how we are going to calculate the same figure by using the shortcut? Just look at it. First of all, we will be picking up the cost of the asset. I want you people to listen and watch carefully. First of all, we'll pick up. Noreen, don't worry. I'm just calculating it again using the shortcut method, right? The cost of asset is 1800,000. That is at 0.0. After 1 year, it will just be 75%, as it will be depreciated by 25%. Is that clear for everyone? Why I took 75%? Because after 1 year, it will be depreciated by 25%, right? And after 2 years, it will be further depreciated by 25%. So I'll just take another 75%. And if I multiply it by 75% again, it will give me the WDV after year 2. And since I know I have depreciated it for 3 years already, so I'll show another 75%. So by multiplying the cost of the asset by 75% thrice, we will get WDV after 3 years. And instead of multiplying it by 75% 3 times, we can just simply take power. So I'll just take power 3. It will do the same thing. So by taking power 3, we are actually depreciating this asset for 3 years, right? And I'm just pressing enter to see what will be the WDV figure after 3 years depreciation. It's going to be 759,000. Here we go. This is the amount. So we've got the WDV amount, the written down value, the tax written down value, or we can say it's the unclaimed cost of the asset. So from this amount, what are we supposed to deduct? What are we supposed to deduct from this amount? From the tax WDV, what are we supposed to deduct? Scrap value. Yeah, if there is any scrap value, it should be deducted, which I have assumed to be 200, which is not the case in this question. Just for simplicity, I'm telling you. So if there is any scrap value, let us assume that it's 200. So that should be subtracted. And once we have subtracted the scrap value, we will get the balancing allowance figure, that is 559. But that's not the tax benefit, that's the expense. On this amount, we will apply 22% tax rate to get the tax benefit. 123, the same as we calculated here. Now let us check the question if there is any scrap, whether there is any scrap value or not. Is there any scrap value? There was a point telling us whether there is a scrap value or not. The investment has no scrap value, so there's no scrap value. So if there is no scrap value, we'll just change this 200 to 0. to 0. And let's see what's the answer now. It's 167,000. So that's the tax benefit for the last year. So from 1 to 10, 1 means you people did not get it at all, and 10 means it was excellent. So from 1 to 10, just tell me how much it was it understandable. Karen just gave me 6 points, so she's my target now. Karen, can you just tell me the reason why you have given me 6 marks? Is there anything that I need to explain further? Yeah, let us do it again. Let us do it again. The cost of the asset, which is 1800,000. The cost of the asset is 1800,000, which is supposed to be depreciated 3 times, as we have already depreciated it, right? So it should be depreciated 3 times. So we'll just multiply it with 75% raised to the power 3, so that we depreciate it for 3 years. So if we do it, we will get the WDV after 3 years, which is going to be 759,000. And from this WDV, we have to subtract scrap value, which is 0 at the moment. So I'm just putting 0 here. So after subtracting the scrap value, we will get the balancing allowance figure. That is the tax depreciation for the last year. And we will apply a tax rate to find out the tax benefit. 167,000. Is that clear now? Thank you so much, Elsa, for being so generous. Thank you. Okay, now let us move forward. And let me delete everything from here. Okay, so now the tax figure is also adjusted. And do we have any working capital requirement in the question? Do we need any working capital? Is there anything related to working capital in the question? Yes or no? No. So there's nothing about working capital in the question. So no working capital here. Okay. Okay. Now we have initial investment in the form of the cost of the asset, and that's 1800 negative. We do not have any scrap value, but let us write it so that we always know if there is any scrap value, we should be showing it as it is. So initial investment, we are done with the scrap value, and there is no other cash inflow or outflow in the question. So let us calculate the net cash flows for each year. Adnan, we do get tax credit on interest payments, but that is reflected in the after-tax cost of capital. When we will be using after-tax cost of capital, that's where this tax credit benefit should be shown. So let us now calculate net cash flows for each year. 1800 for year 0, and let me copy the formula, paste it here. We'll get 1223 since there are no other cash flows here. Then here we go, 1062.215. This is the net of these three figures. Then these and then this. And let us reduce it to 0 decimal places. Okay, these are the net cash flows. Okay. Now we have okay. We have a question before I move forward. Let me quickly answer your questions. Mahin is asking, sir, in the last attempt question, there was a research and development cost as well. And okay, Mahin, remember one thing, and it's a very good question for all of you. Remember, we always pick relevant cash flows, and relevant cash flows are always related to future. We don't pick up sunk costs, right? Now, if before the decision we have already spent on research and development cost, then the research and development cost should not be included. It should simply be ignored because it will be sunk cost. But if the research and development cost has to be incurred in the future, and because of this project, then we must consider accordingly. And interest payments are incorporated in the cost of capital, but like tax credit on tax depreciation, don't we get reduction in tax payments? Yes, we do get. That's why we take after tax cost of capital. A reduced cost of capital means that we have incorporated the tax credit. Is it missing? No, I've just taken 22%. Here we go. Oh, okay. Sorry. Yeah, I just missed this point. Yeah. Yeah, I just missed it. It's a human error. Excuse me for this mistake. That's a human error. Okay. So now, if you can just hold your questions, and now I'm explaining a very important concept. A very important concept, that is the concept of present value. So, do you people want me to explain the concept or just simply calculate the present value? Yeah. So, I'll be explaining the concept of present value, right? Yeah. I'll be explaining the present value concept because it's very important to understand the concept of present value. But for that, I want you people to listen and watch carefully and hold your questions unless and until I ask you to ask me. Okay. Okay. How much cash flow or how much cash inflow, net cash inflow, do we expect at the end of the first year? Quickly answer me that. How much cash inflow, net cash inflow, do we expect from this project after the end of the first year? 1, 2, 2, 3, right? Yeah. 1, 2, 2, 3. Yeah. Very okay. Okay. Now let us assume that there are no further years, and there is only one single year for this project. And at the end of the first year, this is what we are going to receive. Okay, this is what we are going to receive. 1, 2, 2, 3, and forget about this investment as well. So this project is giving us 1, 2, 2, 3 at the end of the first year, right? Okay, now let me assume another thing. Let us assume that we want to earn a return of 10%. we want to earn a return of 10%. We want to earn a return of 10%. And we are being told that we will be getting a total of 1, 2, 2, 3 after year 1. After year 1, we are going to receive 1, 2, 2, 3, and we want a return of 10%. So how much should we invest today? How much we should invest today so that after 1 year, when we get 1, 2, 2, 3, we not only recover our investment but also get the additional 10%. That's what we need to find out. So just look at it. How much we should invest today? We don't know how much we should be investing today. But let us suppose that we are investing X amount today, right? We are investing X amount today, and after 1 year, we want X plus 10% of X. We want X, that is whatever we have invested, plus 10% of X. So we actually want 110% of X. And what are we getting after the end of first year? That is 1, 2, 2, 3. So it means that 110% into X will be equal to 1, 2, 2, 3. 110% of X. If we take 110% of X, we want this figure to be equal to 1, 2, 2, 3. Only in that way we will be able to cover our investment and 10% of that investment. So can you people just solve for X? Just help me solve this equation for X to find out how much we should be investing today. So you have to just take this 110% to the other side, the denominator of the other side. 1, 2, 2, 3 divided by 110%. It's 1, 1, 1, 1, 1, 2. 1, 1, 1, 2. It means if someone is willing to give us 1, 2, 2, 3 in 1 year's time, and we expect a return of 10%, we should be investing a maximum of 1,112 for that amount. If I give you people 1, 1, 1, 2 today, after 1 year, what do I expect from you? I expect that you will be paying me back this 1, 1, 1, 2 plus 10% of this amount. So a total of these two will be expected from you. 1, 2, 2, 3. Here we go. This is what we are getting. So it means if we want a return of 10%, we should be investing 1,112 today. And in 1 year's time, we will get 1, 2, 2, 3, which is 10% more than what we have invested. So we will be able to cover our 10% return, right? This 1,112 is basically the present value of this amount. This is what the present value is. This is the present value, 112. This 1,112 is basically the present value. That is, it is telling us how much we should be investing for this specific amount today if we really want to get 10% return. That's the concept of present value. So remember, from now onwards, present value of any cash inflow tells us how much maximum we should be investing today to get our required rate of return. So how do we calculate the same figure with the help of discount factor? Discount factor basically tells us the present value of $1, and the formula is 1 plus 10%. I've just assumed that the return is 10% at the moment, but we will change it as per the question. Raised to the power minus 1. So the discount factor at the rate of 10% is 0.909, and we just simply need to multiply these two figures, and you will see that I'll get the same answer as 1112. I'll just multiply these two figures. It's 1112. We've got the same answer. So what we have to do is we just simply need to multiply the cash inflow with the discount factor to see how much maximum we should be investing for this particular cash flow today to get our 10% return. That's the concept of present value. So you should not be only knowing how to calculate the present value. Being a professional accountancy students, you should always know how to interpret a figure. If anybody asks you, what's this 1112? Don't just tell it's the present value. Tell it it's the maximum that we should be investing today against this particular cash flow if we need a 10% return. Is that clear? Tell me from 1 to 10. So let us now see whether we have what is the cost of capital. Let us see what's the cost of capital in this question. The cost of capital is 12%. So instead of writing 10%, we should now change it to 12%, as I was just trying to explain it. 12%, and I'll make the changes here as well. And now I'll also show you a shortcut of how do we calculate this discount factors using spreadsheet. Just look at here. 1 plus 12% raised to the power minus, and instead of writing minus 1, we should connect it with this raw. I'll just connect it with this, and if I just press enter, it will be 0.893, and all I have to do is to copy this and select all these three cells and paste it. So I'll just get the discount factors for all the 3 years. I do not need to adjust anything because it will automatically change the cell reference as I copy it to the next cell. It has already changed it. So this is how we do it. So let me repeat it. You can save your time by applying this. 1 plus 12% raised to the power minus this. Okay, and let us copy and paste it in all the rest of the cells. And now let's change the decimal places up to 3 decimal places. Okay, now we just simply need to multiply to get the present values. So it's easy now. Just copy, paste, 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 and paste, copy, paste. So we've got present values. Now, for this particular cash inflow, this is what we should be max investing at max. For this particular, this is the maximum investment today. For this one, this is the maximum one. So the total that we will be willing to invest for all these cash flows will be the sum of all these. This is the maximum we should be investing. We call it present value of cash inflows. And for your information, we should be saying that this is the maximum value of investment. We should not be investing more than this if we require a 12% return. So this is what we are willing to invest. And how much is being required? How much we are required to invest? I'm afraid that you people will not be having that function of NPV on your in your exams. So how much are we supposed to invest? What is the required investment for this project? This is what we want, we are willing to invest. How much are they expecting us to invest? Now, 4309 is the maximum that we are willing to invest if we need a return of 12%. They are asking for 1800, right? And we are okay with investing 4309. So how much less they are expecting us to invest? How much less they are expecting us to invest? 4309 minus 1800, 2509. So we are good with investing 4309 even, because our required return is a minimum of 12%. For that, we are willing to invest 4309, but the required investment is well below this figure. So what do you people think? Should we be investing in this project or not? Yes, because even if we invest 4309, we will still be getting equal to our cost of capital. We will still be getting a return equal to our cost of capital. And if we are required to invest less than this, obviously we are going to accept. So that's if they ask us to comment on the acceptability of the project. In case they ask us, only in case they ask us to comment on the acceptability of the project, we will say since NPV is positive, we should accept. Okay, so can we use NPV function on ACC practice platform? I don't think Hassan, there is the functions are not allowed to be used. They have disabled these functions there. So you can always try it there on the day of exam, but I don't think that NPV function will be allowed there. The next question is that Wakas is asking, sir, why you take WACC and not the borrowing cost of capital? Okay. The reason why we have used cost of capital is because cost of capital includes the impact of both cost of debt and the cost of equity. Since we have equity and debt at the same time, we have to satisfy both types of our investors. So we have to ensure that we at least earn enough to satisfy both type of investors, and that's why we are picking up the cost of capital rather than the borrowing cost. Okas, is that clear? Now, I don't think I need to explain it further because I have already explained. Explain any two revisions you have made to the draft evaluation in part A. So just pick any two of the above, which are different from the one that were calculated by the trainee employee, and explain the reason why there is a difference between what we have calculated and what the trainee employee has calculated. So we have already discussed it in much detail. But in past paper, borrowing cost was taken. No way, Vakas. Are you talking about the same question? Or you're talking about any other question? No, no, no. Borrowing cost is only used when you are taking a lease or buy decision. It's only used in the lease or buy decision. That's it. In an investing decision, we never use borrowing cost. We always use cost of capital. Okay, discuss two ways of incorporating risk into investment appraisal process. Do you people have any idea how do we incorporate risk into investment appraisal? Okay. Okay. One of the ways through which we can incorporate risk is using probabilities. Using probabilities. The second method is to use higher cost of capital, that is increasing your cost of capital when you are appraising your project, because if you think that the project is having a high risk, use a higher discount rate and make sure that you get a higher return to compensate for that risk that you're taking. Third, you may also use sensitivity analysis. And fourth is using simulation model. So these are the four ways through which we try to incorporate risk in investment appraisal. So they have just asked us to discuss only two ways of incorporating the risk in investment appraisal process. Okay, I think we should take a 15 minutes break. Should we? Or should I continue? Okay, I'll just go with the majority. Okay, everybody should come up with votings. Quick. Whatever the majority say, we'll go with that. Okay, I think we should take a break, because let's take a 10 minutes break, a small break. We won't be taking a big break. We'll just take a small break of 10 minutes, and after 10 minutes, we'll resume. So just look, just look at your watches and just add 10 minutes and come back after 10 minutes. So, welcome back. Let's go for another question. And this is the question that I'm giving you people for as a home assignment. Try it at home, and I'll share the video solution for this question as well on Google Classroom. So I'll upload this same file on Google Classroom as well. Okay, we have a requirement here. Calculate equivalent annual cost of the 3-year and 4-year replacement intervals for the Beast and advise Cabrera company which replacement interval to adopt. That this type of a question is about asset replacement decisions. Now, what is asset replacement decision? Let's just first discuss that. Asset replacement decisions basically when you are using an asset regularly in your business, like air conditions, split units, like furniture, or any other machine that a business regularly uses in a business, and it has to decide after how many years it should be replacing that asset with a new one. Like we usually replace our cars or bikes, right? In the same way, businesses replace their regularly used assets, but they have to decide after how many years they should be replacing their particular asset. And the best replacement cycle, whether it's 2 years or 3 years or 4 years, the best replacement cycle will be the one that costs minimum. So you may get a question like this question where you have to decide between two or more replacement cycles or two or more options of replacing the asset. Like here it says calculate the equivalent annual cost of 3 years and 4-year replacement cycles. And also we have to recommend the best option, right? So we have to calculate the cost of replacing the asset after 2 years, and then the cost of asset 3 years, and the cost of asset after replacing after 4 years. And then we'll compare the two and see which one is less costly, and we'll choose that one. So let us go through the question. C company is a construction company. It uses a large earth moving vehicle called the Beast to prepare foundations for buildings. It needs to decide whether the cheapest replacement interval for the Beast is 3 years or 4 years. The following details are available. C company purchases the Beast from a manufacturer for 800,000 payable 1 year after delivery. Its resale value will fall by 40% of the purchase price. Its resale value will fall by 40% of the purchase price at the end of its first year of operation. The resale value will then reduce by 25% of its previous year's resale value for each further year of operation. Yearly maintenance costs are 20,000 at the end of its first year of operations, rising by 5% per year. Maintenance must be provided in the year of sale. Yearly fuel costs are $28,000 in the first year, rising by $5,000 for each extra year it is operated. If the beast is operated beyond 3 years, it is subject to a government safety and carbon emissions test. The test would be paid for and would take place at the beginning of the fourth year of operation. Correction of any fault discovered by this test is mandatory, and there is an 80% chance that the test and remedial work will cost C company $50,000 and a 20% chance it will cost $120,000. And the cost of capital is 8%. Ignore taxation, and we have to decide which replacement cycle is more beneficial. Okay, I'm sharing the link to the Google Classroom, code to the Google Classroom. Firstly, tell me, am I audible to all of you? Okay, I'm sharing the code. So if you want, you can join the classroom through code as well. This is the code. The code is visible on your screen. Just note down this code. Go to Google Classroom, click on join the classroom and insert this link. Let us now start this question. Now, let's just first do some calculations for a 3-year replacement cycle. And we will start from the purchase cost first. Now, in which year should we be showing the purchase cost? Quick. Need answer from everyone. In which year we should be showing the purchase cost of the asset? Read the question and let me know. Usually it's year zero, but in this particular case, it's saying that when you receive the asset, you pay it after 1 year. So it's gonna be 800,000. Okay. What will be the scrap value, and in which year it should be shown? Yes, it should be shown at the end of year three, but the value will be, it's saying that it will fall by 40% of the purchase price at the end of this first year. So it was 800,000 into 60%, fall by 40%, right? So it will be 60%. And thereafter, this is after the end of the first year, and then it is going to receive by 25% of its previous year resale value for each further year of operation. So we will multiply it by 75%, then it will be after the end of year 2, and then multiplied by 75% after the end of year 3. So it's going to be 270,000. That is going to be the resale value. Okay. Then we have maintenance cost. We have maintenance costs, and maintenance cost will start from year 1, and for the first year it's 20,000, and it is going to increase by 5% every year. Into 1.05 into 1.05. So these are maintenance costs, and then we have fuel costs, 28,000, rising by 5,000 for each extra year. $38,000. If the beast is operated beyond 3 years, it is subject to a government safety and carbon emission test. The test would be paid for and would take place at the beginning of the fourth year. So since we are not moving into the fourth year of operation, as we are just talking about 3 years replacement cycle, so this will not be relevant in this case. For 3 years replacement, this is not going to be relevant. Since we won't be going for any test, therefore there will be no corrections of any faults discovered, right? Since there will be no test. So that's it for 3 years replacement. I don't think there is anything else that should be considered. Yeah, there's nothing else that should be considered. So we are done with all the cash flows. So the net cash flows will be, these will be the net cash flows for each year. I hope I'm not missing anything. So is it clear so far? Okay, there are questions. You people want to know how scrap value has been calculated. Okay. I'll just show you how scrap value has been calculated. The cost of the asset is 800,000. In the first year, it will be reduced by 40%. That is, it will be just left as 60%. In the next year, it will be reduced by 25%. So I have just taken 75%. And then for the last year, it will be reduced to further 75%. So now let's write discount factors, and the cost of capital is 8%. Okay. So the formula will be 1 plus 8% raised to the power minus, and I'll link it with the cell and just copy paste in all of the cells and reduce it to 3 decimal places. And we don't have anything in the first column, so the net present value for all these 3 years cash flows will be 664,816. What does question mean by maintenance must be provided in the year of sale? It means that in the last year even you have to show the maintenance cost. Obviously, you will be selling this asset at the end of the year 3, so you have to assume that in the last year you are going to spend on maintenance cost, or we are not going to spend on the maintenance cost. So for the clarity's sake, the question has mentioned that you should be assuming that the maintenance will be provided even at the end of 3 years. Because when usually you sell the asset or you replace the asset, you don't maintain it, you don't spend on maintenance because you're selling it. So just for the clarity's sake, they have mentioned that you should be taking maintenance costs in year 3 as well. Okay, now if we keep this old asset for 3 years and then replace it, in that case it is going to cost us $664,816,000, but this cost is for the complete 3 years period, right? Now the problem is when we will be moving to the 4-year replacement cycle. Okay, let's first move to the 4 years replacement cycle and then we'll discuss this point. Let us first calculate the total NPV of the 4-year replacement cycle as well, and then we'll discuss this point. Okay, the purchase cost is still going to come at the end of the first year. Scrap value will now be shown in year 4, and it will be calculated in the same way with an additional year, 800,000 into 60% into 75%, that will be for year 2, into 75%, that will be for year 3, and into 75%, that will be for year 4. So 202,500. So year 4. Okay, maintenance costs will be 20,000, 21,000, 22040, and it will be increased by 5%. Fuel cost will further increase by 5,000, and we don't need net cash flows at this point because we will have to add another line for that test thing, which will be only for the fourth year. Now here we go. We have to go for the test, and if we test it and we find any fault, we have to spend on fixing that fault. Either we'll be spending 50,000, which has a probability of 80%, or we will be spending 120,000, which has a probability of 20%. So which figure should we be taking? Should we take 50,000 or should we take 120,000? Yeah, we have to take the average, the weighted average, which we call expected value, right? So we will be taking the expected value. So either we will be spending 50,000, which has a probability of 80%, plus 120,000 having a probability of 20%. So whenever you get this situation where you are not sure of what exact value you will be spending, then whatever possible values are there, just take those values, multiply them with their probabilities, and add them to get the weighted average value. And obviously, since it's going to be a cash, it's going to be a cash outflow, so let us write it as a negative figure. So it's going to be 64,000. The very average cost is 64,000. I hope it's clear. Sure. Since we are not sure of whether we will be spending 50,000 or 120,000, we cannot take either of the two values. We should better take the average of these two values. And the weighted average value will be calculated like the possible cash outflow into its probability plus the other possible cash outflow into its probability, and then we will be adding the two. Okay, beginning of the fourth year, yeah. The test will be carried out at the beginning of the fourth year, and okay, yeah. So we'll be showing at the start of the fourth year, which will be the end of the third year. So it will be shown at the end of the three years. So there is nothing else left. We have picked all the cash flows. And we will extend this further 1 year and this one as well. So let us now calculate net present value, sum of all these cash flows. It's 829737. This is the resale value. I explained it earlier as well. It's 800,000 reduced by 40% for the first year, further 25% for the second year, a further 25% for the third year, and then for the fourth year. So net present value. Now, if we replace the asset after 3 years, the total cost of this machine will be 664,816, but it will be for 3 years. But if we talk about the 4 year replacement cycle, the total cost will be 829737. And if we compare these two, obviously the 4 year replacement cycle is going to show you a higher value because it's for 4 years. And if we compare these two figures, we are not actually comparing like with like. We cannot compare it in this way. So what are we supposed to do? We are supposed to calculate equivalent annual cost. Why correction of fault is not included in the fourth year? Because the question has asked us to do so. Look at this. The test would be paid for and would take place at the beginning of the fourth year of operation. So beginning of fourth year means end of the third year. So the formula for calculating equivalent annual cost is NPV, whatever NPV you have calculated, and divided by the NVT factor. Simple. So NPV is 664,816. It should be divided by the NVT factor, and NVT factor is basically the sum of the discount factors from year 1 onwards. So sum of these discount factors, since it's a 3 years project, so we have to sum 3 years discount factors. So the sum of these 3 discount factors will be called NVT factor, and the NPV should be divided by this NVT factor to calculate the equivalent annual cost. That's the, you can say it's the average cost per year. Instead of comparing a 3 years cost with a 4 years cost, and it's not the like with like comparison, right? So instead of comparing a 3 years cost with a 4 years cost, we should be comparing a per year cost, that the average cost, with the average cost of that policy. So let us calculate equivalent annual cost here as well. Maintenance cost is paid at the end of the first year. Does that mean it starts from second year? Why would that mean so? If it's saying it's going to be paid at the end of the first year, it means at the end of the first year, that is year 1. Because when we say 1, we mean end of the first year. When we say 2, it means end of the second year. When we say 3, it means the end of the third year. Okay, now we have got the cost, average cost for both options. So what's the suggestion? What should be done? What do you people suggest this company to do? Should it replace after every 2 years and spend 257,971 every year? Or should it replace after 4 years and spend 250,514 every year? Four years replacement cycle. That's going to be the answer. After the end of today's session, I will upload this worksheet with the solutions on Google Classroom so that you people can review it later as well. So if I can get a quick feedback from 1 to 10. Sure, Abir, I will get back to that as well. Thank you so much, Abir. Okay, now someone asked me to solve a lease or buy question, and here we go, we have got a lease or buy question as well. You could have wished for something else as well. Musawir. Neha, the beginning of the fourth year means end of the third year, isn't it? So end of the third year in our investment appraisal, when we let this look at this three, whatever we are showing in this third column means end of the third year. So any cash flow that is any cash inflow or outflow that is occurring at the end of the and at the end of the third year will be shown in this third column. Is that clear? Here 3 does not mean start of the third year, it means end of the third year. Okay. Okay, here we go. We have a question, and that's a past exam question, and one of the recent past exam questions. Yeah, yeah. We take it as 0 because that's the starting point. That's what I'm saying. The start of year 1 should be 0, and the end of year 1 should be 1. Okay, we evaluate whether Hawker Company should use leasing or borrowing as a source of finance for the new vehicle. Now, before I start with this lease or buy question, let me first explain what lease or buy decision is. Firstly, remember, lease or buy decision is a financing decision. right? Tasmia, uh, I'll just look into this as well. But firstly, let us discuss this lease or buy question. A lease or buy decision. First of all, everyone should keep this thing in mind that lease or buy decision is a financing decision. There's a difference between investing decision and financing decision. And the difference is when you have to decide whether you are going to acquire a particular machinery or asset or not. That's an investing decision. For example, I may be thinking about whether I should have a car or not. That's an investing decision. Whether I should be having a car or not, whether I should be having a building or not, whether I should be having a particular land or not. That's an investing decision. But what is financing decision is that what how I'm going to get that car. Should I buy it and pay outrightly and I pay the whole amount at point zero and purchase the asset? Or should I go for a leasing option? Now, I'm not thinking about whether I should be having the car or not. Maybe that's something I have already decided. Maybe I have already decided that I need to have a car. But what I'm not sure of is that I don't know whether I should be buying it outright by paying the full amount at point zero or should I be going for a lease option. That's now a financing decision. It's no more an investing decision. Now, as you people may have gone through PM, your performance management paper, and you must have learned the concept of relevant costing, and that is only consider those costs that are relevant. Now, when we are taking this financing decision, when we are taking this financing decision of whether we should be going for purchasing the asset outrightly or we should be going for a lease option, remember the relevant cash flows will be the financing cash flows, and financing cash flows are those cash flows that will change from one option to another option. Like if we if we go for buying the asset outrightly, it will cost us differently, and if we move towards the lease option, the cost will be different. So if the cost changes with these two options, that cost will be relevant. That cost will be relevant. Now let me give you an example, and you should be telling me whether it is a relevant cash flow or not. Initial investment or the purchase cost of the asset. Is it relevant financing cash flow or not? It is relevant because you only have to pay purchase cost of the asset when you are buying it. In case of leasing, you don't have to pay the complete amount of that asset, rather you have to pay lease rentals. So in case of purchase option, you have to pay that initial purchase price, whereas in case of leasing, you have to pay the lease rentals. So these are the relevant cash flows because they will change from one option to another. Okay, what about scrap value? Is scrap value relevant cash flow or should we ignore in a lease or buy question? Now, remember, scrap value is always a relevant cash flow in a financing decision because if you buy the asset, you own the asset. If you own the asset, you can sell the asset. And if you sell the asset, you are entitled to receive the scrap value. So you will get scrap value in case you buy the asset. But if you change the option from buying to leasing, since in a lease option you do not buy the asset, you do not own the asset. If you don't own the asset, you have no right to sell that asset. If you don't have that right to sell the asset, you cannot receive the scrap value. So scrap value will be there in one option, but it will not be there in the second option. Since this cash flow changes from one option to another option, it's a relevant cash flow and must be considered. Got it? So scrap value is always relevant cash flow. Okay. What about what about the tax benefits on capital allowance? Will it be a relevant cash flow? Tax benefit on capital allowance. Obviously, when you're buying an asset, you can claim the capital allowance. You can claim the capital allowance. If you claim the capital allowance, it will reduce your tax. That is a tax benefit. But that's only when you buy the asset. Because tax authorities, they only allow you to claim capital allowance if you own that asset. If you have the legal ownership of that asset, only then you can go and claim the capital allowance and get the tax benefit. So tax benefit on capital allowance will be available in one option, but not in the other option. So if a cash flow changes from one option to another option, it's always a relevant cash flow. Similarly, lease rentals are also allowable tax expenditures. Tax authorities do allow lease rentals to be deducted from your sales in order to calculate taxable income. Therefore, you get tax benefit on lease rentals as well. But obviously, lease rentals are only there when you are going for a lease option. So, tax benefit on lease rentals will always be relevant. Now, last is maintenance cost. What do you people think? Maintenance cost will be relevant cash flow or irrelevant cash flow? Okay, okay, all of you, whether you are saying relevant or you are saying irrelevant, you both are wrong, because you must be saying it depends. It depends. That's the right answer. It depends. Now, depends on what? If if maintenance cost is borne by the user of the asset, if maintenance cost is borne by the user of the asset, irrespective of the ownership, it means whether you buy the asset or you take it on lease, in either cases you have to bear the maintenance cost. So the cost will not change if you change from one option to another option. Therefore, maintenance cost will be irrelevant in case it is borne by the user of the asset. But if the examiner, or if the exam question clearly states that you have to bear the maintenance cost in one option but not in the other option, then it's a relevant cash flow, because it changes from one option to another option. Every cash flow is relevant if it changes with your decision. If you cannot change a cash flow with your decision, it means it's irrelevant to consider, right? So if you have to bear the maintenance cost, whether if you have to bear the maintenance cost, whether you buy the asset or you take it on lease, in both cases, if you have to bear that cost should not be considered, as it will not help you take the decision. Let me explain this concept, this relevant costing concept, with an example. If you have to apply for a job and you have two options, job 1 and job 2, both the offices both the offices are at the same distance from your home, will distance be a factor changing your decision? Tell me. If both offices are at the same distance from your, it means it's irrelevant. At this at this uh, uh, in this example, distance will be irrelevant, as whether you choose job A or you choose job B, your traveling distance will be the same. So the distance factor will not matter, it will be irrelevant. So you always consider those factors that will change from one option to another option. So let us now start the question. Enough of the concepts. So let's start the question. Hawker Company is about to replace its existing delivery vehicle with a new design of vehicle that offers a great fuel economy. It estimates that replacing the existing vehicles will save running cost of 2,000 per year. Now, if you replace this asset, it is going to save $2,000 per year, right? Okay, tell me one thing. Tell me one thing. Um, will this change with your decision of lease or buy? Will this saving amount change with your decision? The asset is going to make the same amount of saving irrespective if you buy it or you go for a lease option. It won't make any difference. So it's irrelevant. It's an investing cash flow. It's irrelevant for lease or buy decisions because it won't be changing either ways. So let us talk about option one now. The vehicle could be purchased for 34,000 using a bank loan with an after-tax cost of borrowing of 4% per year. The vehicle would have a useful life of 4 years and would have a residual value of $14,000 at the end of the period. Straight line tax allowable depreciation is available on the vehicle. The vehicle would be subject to a government CO2 emission for tax of $600 at the end of each year of operation. Emission tax expenses are corporation tax deductible, so you will get a tax relief on this amount as well. The vehicle's second option is the vehicle would be leased for a period of 4 years for a payment of 6,000 per year, payable at the start of each year. Start of the each year. Okay, that's important. Huh? We will be just considering it in a while. The lessor will pay the CO2 emission tax. Who's lessor, by the way? The one who is acquiring or the one who is. Yeah, the one who leases the asset, right? So here it says that the CO2 emission tax is going to be borne by the lessor. So in this case, in option 2, you don't have to pay for the emission tax. But in option 1, we have to pay for that. So is it irrelevant? Is it irrelevant? Yes, it's a relevant cash flow because it is there in one option, but it's not there in the other option. It's a relevant cash flow. So let us find out which option should be chosen. So let us talk about the buying option first, and then we will move towards the leasing option. Zero, 1, 2, 3, and 4. And tax is paid in arrears, so we'll just move it to 5. So first of all, we have to take the purchase cost, and the purchase cost is minus $34,000. Okay, then we have residual values, scrap value, which will be shown at the end of the 4th year, 14,000, positive value. Then we have tax allowable depreciation, but depreciation should never be shown as it's a non-cash expense, but the tax benefit of this tax allowable expenditure will be shown. So we'll be showing tax benefit on capital allowance. So it's going to be available on a straight line basis. Well, whether it's same or not, in the first case, it is going to be borne by us. In the second option, it is not going to be borne by us. So simply, so that's why it's relevant. So we can say that in one option it is $600, in the other option it's zero. We don't have to pay. Okay, now let's talk about the tax benefits. It's available on straight line basis, which means that every year it will be same, and the first year one will be availed in the second year because of tax being paid in arrears. So it will start from year 2 and it will go on till year 5. Okay, so straight line. Now the formula for calculating straight line depreciation is cost of the asset 34,000 minus scrap value, which is 14,000, divided by 4. Now if I divide it by 4, I get the depreciation amount, and then I have to multiply it with the tax rate to tax rate. Okay, is it okay now? So I have to multiply this figure by the tax rate to get the tax benefit, which is 20%. So 1,000. And since it's available on straight line basis, so for each year it is going to be the same. So the tax benefit for each year will now be the same because it is available on a straight line basis. Okay, then comes the CO2 emission tax. $600 at and when end of each year of operation. Okay, 600 here. No, on scrap value, we won't be showing any tax impact. No need to show it. In a straight line basis, we don't do it. Okay, 600, 600, 600, and 600. These are cash outflows. But as the question says, it's tax deductible. So there will be a tax benefit or tax saving because of this expense as well. So we'll show tax savings. We'll show tax savings or tax benefits on emission tax. And since we are paying tax in arrears, so for the first year, we'll be getting tax benefit in the second year at the rate of 20%. 120. We will save 120 tax because of this expense. And it will remain the same for all the years because of tax being paid, because of the depreciation being charged on straight line basis. So is that clear? Now just take net cash flows. So we've got net cash flows for each of the 5 years. the tax benefit on capital allowance. Capital allowance is available on straight line basis. So in case of straight line basis, how do we calculate depreciation? We take the cost of the asset, we subtract scrap value from it, and we divide it by the useful life, which is 4 years. And if we do that, we'll get the tax. Get the capital allowance figure for the first year, and if you multiply it with the 20%, we'll get the tax benefit. That is the tax saved because of this amount. So it will be 1,000. Now, on a straight line basis, you know that depreciation will be same for each year, and therefore the tax benefit will also be the same. Similarly, when we are paying tax, the CO2 emission tax, we can claim this as our expense, and it will save our tax at the rate of 20%. So we'll save 20% of 600 as our tax liability. We'll be saving our tax liability. Okay, now it's turn to pick up the. Okay, now we are going to pick the cost of capital. Now remember one thing. Here we go. We have cost of capital of 8% in the question, and we also have a borrowing cost of 4% per year. Now remember this thing. Whenever you are taking a financing decision, it is always advisable to take the borrowing cost, and it should also be after tax. So you should be taking after tax borrowing cost instead of taking the cost of capital, since it's a financing decision, and it must be evaluated using the borrowing rate. So discount factors should be at the rate of 4%. These are present values, and let us take NPV now. NPV will be the sum of all these. It's 20302. So if we go for the buy option, the total value of the cost will be 20302, and it will be negative because we are comparing costs. We are comparing cost of buying the asset with the cost of leasing the asset. Now let's move towards the lease option. So I'll just change the format of the lease option since annuity will be applied. So years will be there, particulars, cash flows, discount factor / annuity factor, and present values. Okay, now first of all, let's talk about the lease rentals. The lease rentals will be 6,000 per year, and they will start from the start of the year, which means the first lease rental will be paid at point 0 or 1. Yes, it will start from year 0. So it will start from year 0, and when will be the last payment made? Year 3. Yeah, it's year 3. So it will start from year 0 because it's payable at the start of each year. So it will start from year 0 and it will end at year 3. So what are we talking about? We are talking about rentals. Okay, particulars. And what's the amount of rental? It's 6,000. Okay, since it's annuity, therefore we should not be using discount factor. We should be using annuity factor. Now the problem is annuity factor formula only applies when it starts from year 1. In this particular case, it's starting from year 0 and it's ending at year 3. So for the time being, let us ignore year 0. Assume that it is starting from year 1 and it will end at the year 3. So let us first calculate the annuity factor for 3 years. The formula will be 1 minus 1 plus the rate, which is 4%, raised to the power minus 3, as we are calculating the annuity factor for 3 years. Okay. And then it should be whole divided by 4% rate. So that's the formula for annuity factor. But this is only for from year 1 to year 3. So let us calculate it by pressing enter, and it's 2.775. But since we know that another payment is going to be made at 0.0, and who's going to tell me what should be the discount factor for year 0? It's always 1. So in my value, we have ignored that 1, so I'll have to add that 1. So I will add 1 for that year 0 payment, and from year 1 to 3 we already have calculated the annuity factor. So now it will be a combined annuity factor for all the 4 payments, 3.775, and I just need to multiply it with 6,000 to get the present value of all these figures. 22651. That's the present value of lease rentals. Is that clear? Then we have, since rentals are expenses and they are allowable for tax purpose, there will be tax benefit on these lease rentals. Now who's going to tell me from which year the first tax benefit will start? It should start from year 2. Yes, it should start from year 2, because in the first year the tax liability will be calculated where we will be claiming this expense, and because of the tax being paid in area, we will get the benefit from year 2 onwards. So it should start from year 2, and till when? From 2 to 5. Very good. And we're talking about tax savings on rentals, and it should be 20%. Yeah, it should be 20% of the above amount, that is 1200, and it's from year 2 to 5. It's from year 2 to 5. Let us first calculate annuity factor for 5 years, and then from that we will subtract factor of 1 year. Factor of 1 year, right? So let us first calculate it for 5 years. 1 minus 1 plus 4% raised to the power minus 5 whole divided by 4%. This will give us the annuity factor for complete 5 years, including the first year. But since we know that we are not going to get tax benefit in the first year, we have to subtract discount factor or annuity factor for the first year. So we have to subtract. For that we need to calculate annuity factor again. I'll just copy this formula again. Put a minus sign, paste it again, and just need to change the year from 5 to 1. So first I have calculated the annuity factor for 5 years. Then I have copied the same formula again, subtracted from this, and now I've just changed the year from 5 to 1, as we won't be getting any saving in year 1. So I have to subtract. That's 3.490. This is the annuity factor from year 2 to 5. Is that clear? A quick yes, because we have 7 minutes left. So I have to wrap up the question. Is it clear? Okay, now let's just multiply with 1200, and now we have got the tax savings as well. So is there any other cash flow in case of option 2? uh, there was supposed to be a CO2 emission tax, but since they told us that it will be borne by the lessor, so we won't be paying any tax on uh, carbon dioxide emission, and hence there will be no tax saving in that regard as well. So these are the two only cash flows. So let us add the two, and that's the NPV in case of leasing option. So what's the decision? What's the decision? It's cheaper to go for the lease option in this case. Therefore, we should be going for the leasing option. That's lease or buy for you. From 1 to 10, I need a feedback from everyone. Now, depreciation is non-cash expense and we never include it in our NPV calculations. Sure, I'll try that we solve one with working capital tomorrow. So we are heading towards the end of the session. If I can have a quick feedback for today's session. Was it useful or not? Thank you so much for the feedback, that lovely feedback. And Michael, as far as your question is concerned, and someone else has also asked about why do we use a borrowing rate? Because since it's a financing decision, and for all the options that we have in a financing decision, we should be using the same rate. We can't use different rates, and that same rate should be the borrowing rate. We only use cost of capital when borrowing rate is not given in the question, or we have to go for investing decision. So we use cost of capital for investing decisions and we don't use it for financing decisions. And tomorrow we will be going through MCQs and MTQs of the investment appraisal, and probably we'll be starting uh, uh, solving questions for, and we will also be solving a few of the questions related to cost of capital. And if we get some time, we will also do questions for business valuation as well. Right, I have written my WhatsApp number on your screens. You may be able to see that number. I hope you can see it. That's my number with a country code. Yeah, we will have a WhatsApp group, but I'll just communicate uh, that when we will be having a WhatsApp group. But for now, we can interact on the Google Classroom. So you can just join Google Classroom and we can interact on the Google Classroom. So I hope that you people can see my number on your screens: +92 321 260 4033. Okay. I don't know what's time is it at your place, but it's already 11:30 p.m. here in Pakistan. So have a good night and see you people tomorrow. Thank you so much. Since you people have given me your feedback, I'll give you my feedback. You people are amazing. You've been so interactive, and when we have online sessions with interactive sessions like you people made it, so it's always great to teach online. Thank you so much. Bye bye.